Hello everyone! In this video, we'll talk about the beginning of DeFi 2.0 and how this model is one of the most revolutionary things happening in the crypto world. We'll also look at the first project that triggered the DeFi 2.0 movement, Olympus DAO. Currently, the annual return of the Olympus project is 7,000%. Yes, that's right, not 7%, but 7,000%. You're probably wondering how this is possible. Is this a scam? The short answer is no, this is a revolutionary business experiment. The DeFi 2.0 theme itself is a more advanced category than the crypto world. Its new innovations are exceptional and have many opportunities most people haven't heard of. The big crypto revolution right now is POL, Protocol-Owned Liquidity. In Q1 of 2021, Olympus DAO was the first project to implement this model. Protocol-Owned Liquidity means that the protocol has its own liquidity. This is something absolutely amazing as it breaks the current model and improves it. Hello friends, and welcome to The Successful Investor. This is the place where we learn and invest. Current models, or so-called DeFi 1.0 protocols, do not have their own liquidity. You can imagine these protocols as an empty pool without water. The protocols try to put concrete into it so it doesn't leak water, but the protocols themselves don't control or possess the water. In this example, the water is money. In order for these protocols to work, people need to provide liquidity, in other words, money. The risk here is that there may be a so-called bank run. This happens when everyone withdraws money from these protocols at the same time, drying them up so they go bankrupt. The same thing happens in the physical world when people withdraw their money all at once from physical banks. This is no longer possible in the case of POL protocols because they have their liquidity and can't be drained because of a great panic caused by fear in the markets. Thus, the capital of the participants is protected. Another main potential problem with this model that's solved is the sustainability problem of DeFi 1.0. The current sustainability problem is that the money leaks from the projects, and there are no funds left to keep the project developing. The third major and huge plus is that this model gives a so-called floor price to your token, the price below which the token can't fall. We'll talk about that in a moment. Everyone from the past year in DeFi aims to earn as much profit as possible from incentive programs, money that's distributed to people using certain DeFi and crypto applications. The only reason people use new applications is to drain the projects so the price decreases. People then jump to newer applications, killing the model, leading to delays in the crypto innovations. Even if the project is very good and revolutionary, to attract users, the project must create its own token and distribute dividends, or give away cash prizes or high returns. This money is then distributed to the owners with certain DeFi and crypto applications. If you're wondering where the money comes from, it comes mainly from the pre-sale sales of tokens, external financing from funds, and most currently, NFTs. However, the moment this pre-collected money phase finishes, the applications can die. This problem is solved by the protocol-owned liquidity model, because in this way, the new protocols do not need to hire liquidity, just to buy it directly. In these terms, they own their own liquidity. The main figure behind Olympus is Zeus, who is an anonymous character but has already had many interviews you can find on YouTube. Zeus has said that the current DeFi 1.0 model works in such a way that the protocols pay rent. At some point, they even run out of money to pay the rent. In 2018, 2019, and 2020, when the main DeFi 1.0 applications such as Uniswap, Aave, Compound, Curve, MakerDAO, and others were launched and imposed, they had no competition. They were the first projects of their kind and easily collected liquidity. They currently have a significant network effect, but only because they were the first protocols to continue innovation. For these projects to be sustainable long-term, there must be additional protocol construction above the current model. If we could describe the differences between DeFi 2.0 and 1.0, it would be the following. DeFi 2.0 is a much more sustainable model and ideology, and puts the health of the protocol first. Protocols should be built like companies. If a company is not profitable and doesn't make money, it goes bankrupt. Currently, 99% of protocols don't make money, but if they don't lose money, the only thing that supports them are the incentive programs. Let's go through Olympus DAO and the way the model works. The idea of Olympus DAO is to play the role of a decentralized reserve currency. The protocol began as a normal DeFi protocol and amassed its initial liquidity thanks to the artificial distribution of high annual percentage yield, or APY. Soon after, the project started implementing the revolutionary idea of bonding. Let's say you want to buy 1 unit of the Ohm currency. Olympus DAO offers the option to buy Ohm with a discount. For example, at the time of making this video, the price for 1 Ohm is $800. The protocol will give the option to buy this Ohm for $760, which is 5% off. The purchased amount goes through the bonding mechanism and is vested for a period of 5 days. Owners are paid 20% of it every day, once every 8 hours. In other words, 15 payments in 5 days. This is done so there's no way to constantly arbitrage, which leads to a dramatic fall in pricing, preventing the price of Ohm from falling to zero. This 5-day period is called a vesting period and is meant to eliminate the risk of people constantly reselling tokens for a profit. Your amount is paid out in 15 increments during 5 days. That's 3 times a day, once every 8 hours. This is called 15 epochs, or 15 time ranges. Here comes the beauty of the model. Since the protocol is the thing that creates the Ohm currency, when you deposit $760 in the treasury of the protocol, it becomes a net profit for Olympus DAO. In the documentation of Olympus DAO, you can see how they state that behind every created Ohm token, there is at least one DAI. DAI is a crypto-backed stablecoin. One DAI is always equal to $1. In our example, when you deposited $760 in Olympus, Olympus takes $759. In that way, you just approved the protocol to create 759 new Ohm tokens. With this process of creating tokens whenever someone buys them from Olympus, Olympus earns its liquidity, which goes to the DAO treasury. At the time of making this video, the protocol has reserved tokens equivalent in value to over $700 million. On this chart, you can see the growth of the treasury, one of the largest in the entire DeFi ecosystem. A small portion of that $700 million is paid out every 8 hours to all people who have staked their Ohm tokens. Ohm tokens that are staked are converted and called staked Ohm tokens or SOM tokens. The money from the treasury is paid in the form of Ohm. Currently, if you stake Ohm, the return on the platform is 7,500%. If you get 1 Ohm after 1 year, you'll have 76 Ohm tokens. Here, it's important to say that this return changes over time. On this chart, you can see what the return was from June 2021 to the end of November 2021. The peak here was 180,000% APY. Subsequently, the return stabilizes for about 1 month between 15 to 18. Currently, at thousands of a percent for a period of 2 months, the returns have stabilized at levels between 7,000 to 8,500%. Over time, the return will likely continue to decline. Now here comes a question. How is the Ohm price determined? And how does only $1 worth of DAI back each Ohm, but at the same time, trade for $700 to $800? This isn't determined by the protocol. The price is determined by market dynamics. Over time, however, the price of an Ohm will undoubtedly fall due to the simple reason that more and more Ohm tokens will be created. However, at the moment, it's not clear when the price will start dropping because of this inflationary pressure. The Ohm price can be seen on this graph. In the long run, the risk of investing in this project lies mainly in the fact that the concept is new, but an important thing to understand is that one would not invest in these protocol-owned liquidity projects for the increase in token price. The investment is made for the passive income received from staking. Another interesting thing is that the free float supply of Ohm is very small, as 90% of the total circulating supply of Ohm is staked. Only while the token is staked can people gain passive returns. Another way that Olympus raises funds is through Olympus Pro. It's a mechanism in the platform that allows other protocols to offer their bonds so they can buy their liquidity and become more sustainable and stable. For this service, Olympus earns 3.3% of all transactions, which goes to the treasury. If you're wondering what the 3.3 symbolizes, it symbolizes the ideology that if everyone does what is best for the team, all will be happy, like if you staked Ohm in the Olympus DAO app. Now here comes the question. Isn't this a Ponzi scheme? What happens if people stop entering the project? What happens if the token sells out? Let's theorize. If suddenly the treasury of Olympus stops growing, this chart describes how many days the current return will last. The current return of Olympus is 7,500% per annum. That'll be enough for the next 314 days. That is, if nothing changes. This refers to the amount of people who are staking. And if the treasury stops growing, the money will run out after 300 days. If the return falls to 5,000%, which is shown in the blue line, the current money will run out after 348 days. If the return falls to 2,500% per year, which is the red line, the money will run out after 423 days. Okay, so we found out how long the so-called runaway is if the treasury stops growing and if the number of stakers stays the same. But what if the treasury stops growing and the price of the Ohm token starts to fall sharply? Then what? This might happen if a lot of people unstake their SOM and sell their Ohm tokens. As we said, the Olympus DAO protocol is an experiment. There's not a lot of history to learn from. It's possible that if the price of Ohm starts to fall, people could unstake their Ohm and get off the platform. However, the platform is still safe. If this happens, the price of Ohm will fall, but returns will begin to rise as money from the Olympus treasury begins to be distributed among fewer people. Eventually, new people will be lured by the high passive returns, and people will re-enter the project. If you stake in the long run, you'll always be at a profit, as the high passive returns beat the price drop. But here's a question. What if Ohm drops to zero? This is the amazing part. Ohm is the first crypto project to have an intrinsic floor price, a price that the token can't fall below. This is called risk-free value, or RFV for short. Ohm itself is not pegged, meaning fixed. It's backed by all the assets that are in the DAO treasury. For example, Tether or Coinbase's USDC stablecoin are pegged stablecoins, meaning the upside movement is restricted, but the downside is too. Hence, the price is fixed. Backed, on the other hand, means the price has a limited downward movement, but no limit going up. Currently, the price of an Ohm is $800, but the assets behind an Ohm are worth $164. Right at this moment, the price of an Ohm cannot fall below $164. We find backing per Ohm by dividing the treasury by the number of Ohm tokens in circulation. This model is absolutely revolutionary. It allows us to analyze a DAO token just like a company. Just like with stocks, there's book value per share and there's share price. Backing per Ohm plays the role of book value per share, or BVPS, while the current price of Ohm plays the role of the current share price. It's completely normal for the price of Ohm to be traded above the real value of its assets, since the token pays out passive income just like a stock dividend payment. This innovation is a huge leap towards stability and lower risk investing. In theory, Bitcoin could fall to zero, but an Ohm, in theory, can't. If this starts to happen, the Olympus protocol will start to burn Ohm tokens, and the price will rise above the backing value of the assets. This is an experimental project, but is currently insofar extremely successful. If it continues in the same direction, the model will be remembered in history as one of the most revolutionary economic models. The returns in these projects range from 30,000 to over 100,000% return per year. Before investing, however, please do your own research and make decisions carefully. Fake copies of this model can be scams, so it's important to know which is legitimate and which isn't. If you appreciate what we do in these videos, you can join our Patreon page for the price of $1 per day. You'll get access to analyses and information on many of the early stage projects we've researched. We'll also cover projects that haven't yet released their token sale. You could be among their early investors. In the future, we'll provide detailed analyses for Olympus, Wonderland Time, Clima DAO, Reserve DAO, and many other similar projects. Even people like Mark Cuban stand behind the Clima DAO project and realize how revolutionary the protocol-owned liquidity model is. Thanks for watching. If you enjoyed this video, please leave a like and subscribe to our channel. See you next video.